This is Scott Becker with the Becker Private Equity and Business Podcast. We're joined today by regular guest Matt Wolf of RSM. RSM's the best in the business in mid-market private equity. We're talking to Matt today about what to expect now that interest rates have started to come down. Matt, are we going to see a return to the go-go 80s, the roaring 20s? What are we going to see in terms of deal activity, or even 2021? What are we going to see in terms of deal activity now that the Fed has started to lower rates? What are you saying, and what are you thinking?
Yeah, it's $1 trillion question, right, Scott? And certainly deal activity is going to increase, right? Like anecdotally, I can tell you even yesterday, as they were recording this the day after the FOMC decision, yesterday afternoon, we had an increase in inbound calls on deal flow and stuff, which may be a coincidence, I don't know, but definitely has ignited a little additional fervor to get some deals done, right? Easing the financing conditions, all else equal, there's going to be at least more interest in deals. Now, I think what's going to be interesting and what makes this comparison difficult is, the focus on future deal making, now that the interest rate path downward is a little more clear, and we got a nice big cut yesterday, is how much of the deal activity will translate into closed deals. My sense is the next few years won't look like, say, for example, 2016, 17, 18, right? Sort of the run up to the pandemic, which was a, fairly normal-ish kind of middle market deal flow period during the prior cycle, right? Which kind of defined, as we've talked about on the show before, the period between the global financial crisis and the 2022 interest rate increases was this era of generally zero real interest on debt. And, it supported strong deal flow. But the investment thesis there, particularly towards the end of that cycle, was growth at all costs. And, so as we look and make comparisons and try to figure out what does this mean for future deal flow, you kind of alluded to it earlier. I think we almost have to look to prior cycles, because going forward, 50 basis point cut yesterday, potentially another 100 to 200, maybe even more basis points over the next year, it's not going to revert to a zero interest rate policy where investors are buying anything they can to capture growth and market share. Sponsors are going to, and I guess the prudent sponsors will be looking at operational efficiencies, scalable cash flow, financial sustainability, and fiscal policy tailwinds. And that's just a more complicated deal-making process. So that's a long way of me saying, Scott, that we're certainly going to see, and already I think are seeing, increased deal activity, deal interest. But what remains to be seen is, are we going to see what sort of close rate are we going to see on these deals? And I think it's going to be lower than what we had in the run-up to the pandemic, right? Sponsors are going to spend more time, more energy, more money on fiscal, operational, all sorts of diligence. That entire process is going to be longer, and they're going to be willing to walk away from more deals that at the end of the day, even the 11th hour, just don't make sense.
So you've got private equity funds working at two very conflicting goals. They don't have to be totally in conflict, but one goal is to have a reason for being for their investors and for their people. They need to put money to work. They, in fact, don't get their management fees unless they're calling capital and putting money to work. To run the engine, they've got to do deals. So that's one pillar of where they have to be. The second pillar is they need to also do deals that ultimately are profitable, because just making management fees and not making profits doesn't work for their investors and doesn't work ultimately for the private equity fund either, who lives on the 2 and 20 mandate. So you've got this pressure to start to put money to work. Some of that's been very soft the last couple of years. Then you've got that pressure to do good deals too. And what do you see out there in terms of those two big issues, needing to put money to work, but also need to do good deals? What does that look like? What does that look like as people trying to assess? And maybe it's really what you're talking about. There's going to be a lower close rate as people are more careful on the deals they do. But what are you sensing out there?
Yeah, I think a way that sponsors or investors really in general are going to thread that needle is through more and more complex purchase consideration structures, right? So, typical cash plus maybe some rollover equity won't get a lot of deals done going forward. There will be more complex incentive units issued, complex earnouts with milestone targets to align management teams and sellers to create the synergies that these deals are being predicated on. Right. So, and this will also make cross deal comparison valuation multiples much harder to compare. Like I guess at a high level, kind of stylized example, let's say you have a company that in 2017, $20 million of EBITDA, and somebody would have paid, all right, 80 million cash and $20 million in rollover equity. You get $100 million consideration at 5x EBITDA. Maybe that's a typical deal for that industry. Going forward, that same exact company, $20 million of EBITDA, that purchase consideration might look like $40 million of cash, $30 million of rollover equity, and a host of complex earnouts based on reaching profitability targets or we're even seeing, and I expect we'll see more, milestone targets of either launching a new product or converting a technology stack to new systems or whatever they think will drive the synergies that make that company worth quote unquote $100 million. They're not going to give it all up front. The buyers will use complex purchase consideration structures to protect their downside. So if that profitability doesn't materialize, they're not putting as much capital at risk. So, and that alone leads to longer deal negotiation, longer diligence, longer deal periods. But that's really, I think, the primary way we're going to see buyers and sellers thread that needle, despite those sort of conflicting tensions.
Just fantastic. And what you're saying is there's this old concept of trying to do deals where 1+1 = 3. In the old days, it might have been simple multiple arbitrage. And, we buy something at a 10, we buy another something at a 12, because we now built a much bigger, less fragile company. We could sell it at a 15 multiple. And what you're saying here is there's going to have to be more conviction around deals for deals to get done, not just bigger is better, but some synergies, some ways of actually making it more profitable so that you got a better company on the other side of the deal. And not always easy to do. I mean, we've seen plenty of it where it's not worked out and plenty of it where it has worked out, and some are better at it than others, quite frankly.
Absolutely. And I think, the other dynamic of that is the management team has always been critical to the success of an investment in a portfolio company, right? Always critical, even in the era of free money, when really monetary policy and financial engineering and the multiple arbitrage you're talking about was the primary driver of returns. It was the primary driver, but it wasn't the only driver. Still needed competent, qualified management teams. Going forward, the pressure on those management teams to deliver the synergies, to deliver that sustainable financial growth will be even higher. And it will be even more critical to have the right teams in place. And these teams are going to have to deploy leadership, management, executive skills that haven't really been rewarded in the broad middle market marketplace for 15 years. And so that dynamic too is going to also lead, extend diligence, extend deal making processes as these sponsors really hone in on getting the exact right management team.
No, thank you. We're seeing more turnover of management teams than we've seen in some time as well. And I think that's fascinating as well. Matt, it's always great to visit with you. We're all excited to see movement, to see more movement. And let's hope, as always, that it's smart movement, just not movement. Matt Wolf, one of the best in the business from RSM, thank you for joining us on the Becker Private Equity and Business Podcast. Thank you very, very much.
Thank you, Scott.